What's good, YouTube? It's your boy Charles Enoch, and you're watching Invest in Myself. So welcome to Recap Wednesdays, where I'll be showing you highlights of last week's episode. My videos tend to be a little on the long side, and they can be a little drawn out. So for those that learn pretty quickly, this will be a shorter video, basically hitting the main concepts on what you need to know. Also, at the end of Recap Wednesdays, I'll be letting you know what will be the next subject for this Saturday's video. Also, my goal is to get 10,000 subscribers by the end of this year. I know it's a crazy goal, but it's my goal. So I need you guys' help to make this happen. So if you're new to the channel, take a little time, hit that subscribe button. Also, remember to hit that like button for me. Both these things help me reach a higher audience base. So I appreciate the love in advance. So today I want to talk about how to pay off your credit cards by using your credit cards like a bank account. Meaning you will be putting money in your credit card and then you will draw money out of your credit card. When trying to pay off your credit cards in the most effective way, we do want to adopt the velocity banking strategy of income pays credit, credit is going to pay our expenses. See, when we're able to put money onto our credit card, it reduces our interest. And if we're able to pay the credit card statement off, then we avoid interest altogether for that month. Now, the only way this strategy works is if you have a positive cash flow, meaning the income that you're bringing in is more than the expenses that's coming out. So not in all cases can you avoid interest, but you can reduce your interest significantly when you're putting the money onto your credit card. Now, I know this may sound confusing, but you already know I got the whiteboard in the back. I'm gonna have a real life example for you guys. So let's get started. Let's get to it. All right, so we're on the whiteboard here. Let's break it down. You already know I get down to business here. So we're gonna have an individual. We're gonna say that their income per month is $4,000. Their expenses are $3,650, meaning their cash flow is gonna be $350, pretty much income minus expenses, right? Now, the debt that they have, they're gonna have 3 credit cards that they have a debt on. We're gonna just say that the interest rate is 25%, so it's a high interest rate here. So credit card 1 is gonna be maxed out. They use $950 out of the $950 they have available. Credit card number 2, they use $375 out of $600. And credit card number 3, they use $570 out of $700. Now the minimum payment on each of the credit cards we're going to say is $25 each. So that's the minimum they have to pay per month on the credit card. Now, the expenses they have to pay in cash is going to be the rent. The rent is going to be $1,800, and they have a loan, and the loan is going to be $800 that they have to pay on, and they can only pay cash on that. So that amount's going to be $2,600. Now, the expenses that they can pay via the credit card will be their internet bill is going to be $100, electric is going to be $80, car insurance is $200, car loan is $300, gas is $150, and groceries is $220, which leaves that at $1,050, pretty much totaling their expenses of $3,650. All right, so we're on the other side of the board. So let's break this thing down, see how this individual is going to use the velocity banking strategy to pay off the credit cards by using the credit cards pretty much like a bank account. All right, so month 1, we're going to use cash to pay both the rent of $1,800 and the loan that this individual has of $800, totaling $2,600. So remember, their income is $4,000. So however they're getting their income, weekly, bi-weekly, whatever, they're going to save $2,600 in cash and use that to pay the rent and the loan. Now the remainder of their money, $1,400, the remainder of that $1,400, they're going to put onto the credit cards. So they're pretty much going to be transferring this money onto the credit cards. So credit card one, they're going to be putting $950 on credit card one, meaning that they paid it off in full. This avoids the interest on credit card one. So we avoided 25% interest. Increases our cash flow by $25 because it's no longer an expense, right? Now credit card two, we're going to put $375 on credit card two. That also pays off credit card two. We avoid any interest, increases the cash flow by $25 because that was the minimum. It's no longer an expense. Now credit card three, we're going to put the remainder of our money. We only got $75 left on credit card three. So we did not completely avoid interest, but we did reduce it, right? Because we put 75 on it. It's better than putting 25 on it. Now, what we're going to do, we're going to pay our expenses with our credit card, the remainder of our expenses. Remember, the remainder is $1,050. So first, we're going to use credit card one. We're going to pay $950 on credit card one, pretty much maxing it out. But again, we don't care because when we use that payment, when we transfer $950 onto the credit card, it's going to say that we paid it off and it's going to move it towards next month. So it doesn't matter if we max it out, right? So credit card number three, we're going to pay $100 on there because we got to pay $1,050. So now we've completed all our expenses for the month. So the credit card balance, this is how it's ending. Credit card number two is paid off because we didn't use any money on credit card number two. So that's paid in full. Credit card number one has a balance of $950 on it. Remember, we avoided any interest on there. Credit card number three has $595. Remember, we put $75 on there and then we had to use 100 of it. Now, in this example, we did not calculate the 25% interest on there just to keep it simple. But this is how it's outlined there. So we're on month number three. We're repeating the same cycle. I think we're getting it, but we still gonna hammer it down, right? So month three, we got to use $2,600 of our income, the cash, straight cash. We're gonna pay the rent, $1,800. Keep a roof over our head, and we're going to pay on the loan that we have. So that's $2,600 out of our total $4,000 income. Now, the remainder of our income is going to be $1,400. We're shoving that money onto our credit card. We just transfer it onto the credit card, right? The money is not lost. Once we put it in, we can instantly use the credit card. So again, we're going to avoid the interest on credit card number one by putting $950 on there. Credit card number three, we're going to avoid interest actually because we're going to pay it off the $245. Now the cash that we have left over, because if we add both of those up, it doesn't equal $1,400. So the cash that we have left over is $205. Now this step, you're going to first pay your expenses with the extra cash that you have. So you have $205 and the expenses that we owe are $1,050, right? So we're going to use $205 of cash and then we're going to use credit card one and we're going to get the remainder amount. We're going to use $845 on credit card number one. So the credit card balance now, credit card two, it's been paid in full since month one, right? Now, credit card number three is actually paid in full now. So now we're just focusing on credit card number one, $845. That would be the balance on there. Now, again, credit card number one, we have not paid any interest at all. Remember, when we transfer that money onto the credit card, it says that it's paid and then it's going to push the due date payment back to the next month. So that's why we're doing that transfer, and then we're just charging our card, right? Doing the cha-cha swipe. So month 4, I think we got it down, but let's finish it off month 4. So we're gonna use cash to pay, again, the rent, the roof over our head, $1,800, and then the loan of $800 that we have, that's $2,600. Now the remainder, our $1,400, we're gonna use $845 to put on credit card number 1, right? Do the transfer, that pays it off in full. We avoided any interest on there. Now, the difference of the $845 and $1,400 is $555. So we're gonna use the $555 that we have left over in cash. We're gonna use that to pay majority of our expenses. Remember, our expenses are $1,050. So once we use $555, we're going to use credit card 1 and pay the remainder, $495 on credit card number 1. Now, the credit card balance ending for that month, credit card 2 been paid off, credit card 3 we paid it off since last month, and credit card 1, if we take a look, it was $845, that was down to $495. So that's the $350 cash flow. Remember, income $4,000, expenses $3,650. So we see that it's going down by $350. So now I don't have enough space on the whiteboard, but we can see if it's going down by $350, we will repeat this step for month 4 for 2 more months, and then credit card 1 would be paid off, and we avoided all the interest on credit card number 1. So again, if you see what we're doing, we're pretty much using our credit cards like bank accounts, right? We're just depositing our paycheck onto the credit card, pretty much paying that off in full, and then we're withdrawing, we're pretty much swiping our card using the money that we put in to pay the expenses that we can pay. So when you're doing this method, you first, number 1, want to figure out what you can and cannot put on your credit card, right? So for this individual that I did, we seen that rent would be wise to pay in cash, and the loan that this individual had, pay in cash. Everything else we could pretty much put on the credit card. So anything that we can put on the credit card, we're using our cash to deposit it into our credit card, and then using our credit card to pay that expense. All right, so thank you for tuning in to the end. So next week's episode, we're going to be learning why you shouldn't be saving your money, rather you should be investing your money. We'll be using a velocity banking strategy so you can invest your money rather than you worrying about saving up your money for a rainy day. So remember, tune in this Saturday, and we're halfway through the week, so hopefully everybody's getting through it smoothly. Peace out.